here's how this works. We've already got the Trump pump. The market has rallied up pretty strongly, and on the enthusiasm that maybe less regulations and $1 trillion worth of infrastructure and lower taxes are going to lead to much stronger corporate profits. So we got the Trump pump. Now we're going into the period where we say, well, can he really get it past Congress? Are the Democrats in the Senate going to go along with this? Maybe he can't really put all this good news together. And so now we're going through the disappointment phase, and where we're going through the profit-taking phase from the initial Trump pump. That's where we are in the market right now. Now, then what's going to happen is we're going to go into the more sustainable bull market, where we start to be realistically appraising what's going to get through Congress, what's not going to get through Congress. Of course, we have to look at Fed policy as well. And so that's what's going to be coming up here very, very soon. We've gone through this, the first two steps of the three-step process that's going to drive the market. Hey, everybody, Courtney Smith here with our TradeSmith for Tuesday, January the 17th, Martin Luther King holiday, so we took a day off there. And, of course, we would never take a day off from reading this, because every single day it's a good idea to read this because it is so unbelievably important. Now, let's take a look at the markets. You can see here's our sideways price action. Some stocks going down a little bit. Most stocks just going sideways. Unbelievably boring price action. And this is what I'm talking about, the disappointment phase or the profit-taking phase after the Trump pump. Now, you can see that the price action is slightly slanted higher, but the purple predictor is slightly slanting lower. Not enough to really disturb me. I just think we have to be patient and wait for the breakout. I believe the breakout will probably be to the upside, although there is some seasonal negativity here. Dow Jones. I'm substituting a different chart here so we can get a different perspective. So this is a little bit longer term perspective. This is a 1-year perspective, basically. And I left up at the top there the ADX indicator. And there's really 3 lines up there. I already talked about the black line, but the green line and the red line, let's talk about that for a second here. And the green line is what's called DI plus, and it's really kind of a measurement of positive price action in the market. And then the red line is the DI minus, or directional index minus. And you can see they're getting awfully close. And generally speaking, the way you interpret this is if they cross, if the green goes below the red, that's bearish. If the green goes above the red, that's bullish. So you can see back at the beginning of November, the green crossed the red, and that was a great signal to be a buyer. You can see we're getting awfully close to a sell signal here. And, we need to get this market to break up pretty soon, or this indicator could turn negative. Now, momentum here, look at this. This is the NASDAQ here. You can see it's much stronger than the old Dow stocks. We've been focusing on this now for several weeks, that it's the NASDAQ we want to be. It's in biotech. It's in technology. It's not in old-style companies. So this is a good example of that. Purple predictor, very strong here in the NASDAQ. Seasonality, you can see. If we break below that red line at 130 on the IWM, then I'm going to turn my signal to bearish. But it's been bullish for quite some time, and all of our positions we have on for fully paid up members knows we've got some good profitable positions on. They're larger than normal size. This is an important part of the TradeSmith system, is to adjust the size of our positions based on the seasonality of the market. So right now, we're on a bullish sign. Now, let's take a look over here very briefly, because I've gone over it enough. The thing that we should be looking at is the is all post-election, and that's the blue line. And the reason why we look at the blue line is because it has far more data. In other words, we've got a ton of data, all right, a ton of data. The green, red, and black lines, we may only have 2 years of data, 3 years of data. So it's really not a legitimate line, if you see what I'm saying. We can kind of look at it and say it's indicative, but it's not conclusive. So I like to start where we have the most amount of data, because that line should be the most valid. The others may not be valid at all. Well, so all post-election, really the market goes sideways until April, a little bit choppy, no big deal. If we want to go to a Republican first elected, that would be the black line, pretty much the same, a little teeny bit more bearish, 1% more bearish, no big deal. We could go for the red line, which is all first elected, and that has a little bit more data, but and that's a little bit more bearish. But when we get to April, the blue, black, and red lines are all at the same price. So it really doesn't matter too much which one we pick. And you also have to look at the scale. If we even pick the red line, it's like -2 in March. It's -1 for the blue and the black. Well, these are not precise numbers, so I'm counting them all as basically the same. Now, obviously, a Democrat was not first elected, so we don't have to look at the green line, which would have been more bearish early in the year, but more bullish late in the year. So there's our seasonal. This is from Stock Traders Almanac. Highly recommended that you subscribe to them. The yield curve. We're getting past this crunch time, okay? It's been crunching down the market. Once again, it's not bearish, but it's holding the market down. It's holding the market down, and we're going to be releasing that pressure pretty soon, so that'll be good. Asset allocation starting to stabilize. That's slightly bullish. Our stock market risk indicator. When it goes up, that's bullish for the stock market. When it goes down, that's bearish for the stock market. And as you can see, it's starting to creep a little bit higher here. So that is a bit bullish. I didn't like the fact that it was going down while the market was going sideways. I didn't like that. But now we're seeing a little bit of strength here. Global shares. I haven't gotten, except for the Greek market and the Japanese market, I haven't gotten into global shares. There are some other markets that are starting to look pretty good, like the Australian market, but haven't come out with a recommendation on those yet. But starting to see some good action over here. All right, so the Greek market, this has been one that I've been highlighting for some time, and I think this is a good place to be long. I could go into details, but I won't. All right, Japanese shares, we've got this trading range. If it breaks up through 5150 on the DXJ, I am going to get long Japanese shares again. This is going to be a great market. They're continually easing. The yen is going down. This particular ETF hedges out the yen exposure, so it's purely what the stock market is doing. The next leg is going to be higher. Bond market. Ooh, look at what happened on Friday. Okay, so well, wait, you know what? Look at that chart. I want to go to my next presentation. We'll come back here. Every indicator is now calling for higher interest rates. Now, that's pretty unusual. We've been having a mixed bag, but all of them are saying higher interest rates. Now, let's go back over here. Look at this. When bonds go up, interest rates go down. So the bond market had been going up since the middle of December, showing lower interest rates. But that's a kind of an important bar that happened on Friday, and Thursday was a reversal bar down. So it's not conclusive that we're going to start seeing the bond market go down. But when I look at the fundamental factors on the next slide, and then I look at the price action on Thursday and Friday, I'm kind of looking at this and saying, you know what? I think that's the high of this rally, and we're going to start going lower. I'm not ready to short bonds, but I just don't think we should be long them well, I never did get long them, but I mean, I was just waiting for a shorting opportunity. I think we're very close. I think it's going to happen this week. So please pay very close attention to our next TradeSmith. Bond key factors, as I say, are all calling for higher interest rates. Now let's take a look at the dollar. I've got the slanted. You can see we've been under pressure, just as I predicted over the last couple of weeks. The green line, the trend line, it was broken. Big deal. Trend lines get broken all the time. So where's the dollar going to go? Well, I just said interest rates might be going higher. It's the early stages of making that decision. If those interest rates, if the bond market starts to go down, then this could be the low in the dollar. If we ignore the bond market, then I think we could get back down to those old lows of around 100. So we could see the dollar drop another 1%. And I think that's about as far as it's going to go, because this is just a correction in a major bull market in the dollar. And by the way, this is going to affect the economy more than the Donald will affect the economy. All right, gold, same thing. Decent, good rally. And there's some mixed bag here. Let me show you my next chart. For the first time in months, all three of my indicators are bullish for gold. For the first time in months, they're all bullish. Now, the top two, well, they're not very bullish, but they're all bullish. So when I look at my three indicators and I see the price action, I got to find a way to get long gold. I'm not long gold now because my indicators have been bearish to neutral, and I don't want to get into anything that isn't clearly bullish or clearly bearish. But now my indicators are clearly bullish. Now I need a price action to get into the gold market. So I'm starting to get bulled up here, starting to look for a way to enter, but I'm not there yet. Okay, oil. The market's doing what I said it would do. It's struggling now at these levels. I really think we're going to continue to move lower. We've been moving in a choppy way lower now for several weeks, for almost a month. I think that's what we're going to see. We're making a rounded kind of topping formation, and we're going to head back down into the 40s a level again, maybe down as far as 44. So I'm looking for some pretty big moves, sluggish bear market to the downside. All right, everybody, thank you very much for coming to our freebie version of TradeSmith. Look forward to seeing you next week. Fully paid up members, you know what to do. Hang in there, take a small break, and we got some new trades too, by the way, fully paid up members.